Welcome to the Book Club interview with your host, Scott Hollister, a show that empowers you to discover your best self through a deep understanding and review of books dedicated to self-improvement and business.
All right, welcome to the Book Club interview. My name is Scott Hollister, your host. Today's guest is Brian Burke, who wrote The Hands-Off Investor. Brian, welcome to the show today. How you doing?
Great, Scott. Thanks for having me on.
Thank you for being on. Appreciate it very much. So before we get started, you want to tell listeners a little bit about, your background story, where you came from, and why you got started in real estate?
Oh yeah, well, I got started in real estate because I didn't know any better. I was 20 years old and trying to figure out how to make money and work for myself, and real estate just seemed like the obvious choice. So I started looking around. I managed to find this property that I could get for no money down, and I bought it. And the rest was history. I was, by that point, I was hooked, never looked back. So started flipping houses. This was like 1989. It was like 31 years ago now. And so then I started flipping houses, and all throughout the 90s, I was buying, fixing up, and reselling houses. And in the 2000s, I quit my day job, or actually it was a night job, really, and started investing in real estate full time. And I was buying, fixing, and reselling houses. I was buying apartment complexes and duplexes and fourplexes and that kind of stuff. And then the market collapsed, and the rug was pulled out from under everyone in late 2008, early 2009. And at that point, I knew I had two choices. I could either go crawl under a rock, or I could grow like crazy. And I chose to grow my way out of the recession, really expanded the business an incredible amount, started raising money from investors to acquire larger and larger properties and more properties. And literally after the recession, I was buying 100 properties a year, 100 homes a year, and fixing them up and reselling them, plus buying larger apartment complexes. And here we are now, $500 million in real estate, 700 single family homes, 3,000 apartment units later, and still going strong.
Awesome. And I think that's one of your best perspectives, right? Is going through multiple market cycles, having, different areas of expertise that you've gone through over the years. And I think that comes from the book. And that's what I really appreciate about, learning from someone and gaining that knowledge that you've put into a written book. And it's just phenomenal. So it helps develop, a foresight that investors, I think, need most, right? Because we don't have to make mistakes ourselves. We can kind of learn from, not to say that you made mistakes, but,
Oh, I've made plenty.
Yeah.
Everybody will. And, and it's funny, you can read someone else's mistakes in a book and think that you're not going to make them, but you'll still make those mistakes. You'll just go, gosh, I knew better. I shouldn't have done that. And after you've made those mistakes and it's cost you money, you'll never do it again. At least that's my experience anyway.
Yeah, smart. But I love the book. I mean, the unique view, that it offers, there's countless books in real estate investing, but a book from the investor standpoint, right? To how to educate someone with money that may want to diversify their portfolio with real estate. It's such a great idea. So how long has it been in the works, and had you thought about writing it in the past, and what made you write it now?
Well, my wife's been telling me for 15 years I should write a book. And, I never thought I was experienced enough. And it's like, I've only done 500 deals. That's not enough to write a book yet. And then you start seeing hey, somebody just did their second deal and wrote a book. Maybe I could do this. And so, I guess I made excuses for long enough. And, I never really knew what I would write about. I always thought, well, maybe I would write about my story, about how I came from nothing and, bought $500 million worth of real estate. Maybe that would be interesting. And I think, that's been done before, Mm-hmm. So as I was kind of looking into things, actually it was Brandon Turner from Bigger Pockets. We were hanging out one day, and he gave me a suggestion. He says, you should write a book on, how to become an investor or something like that. And so I thought, well, that's kind of an interesting idea. So I started researching the idea, and I found nobody had really done this. There was all kinds of books out there on how to invest in real estate, and there were all kinds of books on how to raise money from other people to invest in real estate. But there was no book for that other person, that, the one that has the money and is being pitched to by a real estate operator saying, I've got this great idea. I'm going to buy this apartment complex, give me some money and I'll invest it. There was no book to teach that person how to know what investment they should make and, what operator they should invest with. And then, how to gauge, what to expect and how things are going and whether it was the right opportunity or not. There was no book to teach that. So I felt it needed to be written. So I started it about a year and a half ago. I cranked it out in about 6 or 7 months. And since then we were in editing for about another 9 or 10 months. And here it is. It's just being released now.
That's awesome. I love it. Well, I find it funny that you didn't think you were experienced at 500 deals.
Yeah,
good,
I guess maybe I'm always not giving myself enough credit. I don't know. I guess I probably knew enough to write a book, but I wasn't a writer, and what did I know? But who knew?
Well, it's great. No, the proof's in the pudding. The successful deals that you have to back it up. I love it. It comes through big time. So, I had this conversation one time. I think I was at a private equity event a couple years ago for IMN, and I met this gentleman who was walking around. He was one of the speakers in the morning, and he started talking to him. We struck up a conversation, and he asked me what I was investing in. I was like, small single families, multis. And then he's like, oh, that's a good start. He's like, my first investment was a 3-unit, and now we're building a 300 unit, ground up construction. So it blew my mind, when you can see someone that can go from just a single family to a massive apartment complex, just that step. So what did that, first initial deal look like? And, what's one of your more recent deals, and how'd you bridge that gap when it comes to education?
Yeah, well, it's funny you say that, because when I was 20 years old and bought my first rental property, my first rental house, I was living in an apartment complex. It was a newer apartment complex. It was a few years old. I didn't even own my own house yet. And I remember thinking to myself, like, who owns an apartment complex like this? So I started doing some research. I found out it was owned by just this one guy that lived in the next county over. And, and I thought, this is probably a 150 or 200 unit complex. And I thought, that's incredible that like one guy could own a whole apartment complex. It was completely foreign to me. I never thought that something like that would ever be possible in my future, for sure. And so, years went by. And, this is probably about 20 years ago. I had a couple of rental houses, and I was selling them. And I thought, I would like to do a 1031 exchange where I could sell these rental houses and buy, something larger, an income property of some sort. But I didn't know anything about how to do that. I didn't know how to underwrite. I didn't know how to analyze an income statement or what to expect. So I connected with a guy who was a CCIM, a commercial broker, that he had been selling a lot of my house flips for me. And it just by coincidence, he was a CCIM. And I said, I'm thinking about buying apartments, but I don't know anything about it. Can you help me? And he's like, yeah, come into the office, sit down. I'll teach you everything you need to know. So I went down there. In like 2 hours, he kind of ran me through this, how to read an income statement and all this stuff. And it really kind of was the jump start for me. A number of months later, he had, actually maybe even weeks later, he had a listing of a 16-unit apartment complex. And he told me about it. And I looked at the numbers and I liked it and I bought it. And that was my first, large multifamily. It was a 16-unit building. It was about 18 years ago. And coincidentally, I actually just sold that like 2 years ago. I mean, I literally held it forever. And then from there, it was just kind of organic growth, and next thing I knew, I was, buying, we bought as much as 500 units at a time.
That's awesome. I love that. The breaking down with the connections and education, and it's great. That's what we all hope to do, right? To grab that book in our hands and hopefully take us from one step to the next, So what does that first point of contact look like with a potential investor that's looking to invest? Why the most important thing I saw in the book was you'd sit down and you'd ask about their goals, objectives, risk tolerance, and priorities. So why is that important for you?
Well, it's very important for us because I want to know that the investor that's investing in an opportunity that we're presenting is the right investor for that opportunity, and that investment is right for them. There's nothing worse than having the wrong investor in the right deal, if you have somebody that says, hey, my goals are, I want short-term growth. I want to double my money. I don't want to tie it up longer than 18 months. And then you've got an apartment complex you're going to hold for 5 years, and you're going to 1.5x the money over 5 years. They're not the right investor for that deal. And if you put them in, they're going to be wanting their money back, or they're going to not be happy with the performance, and that kind of stuff. So we want to make sure that we're matching the right investor to the right opportunity and vice versa. So knowing someone's goals and objectives is critical, because, if somebody is retired and they're using the income to live off of, you wouldn't want them investing in a ground up development deal that has no income, right? So it's just about matching opportunities with investors and making sure you have the right investors in your deals.
Oh, that's great. Now, in terms of what I think the most important thing is, character, and in page 52 in the book, I think is the most important book, page in the whole book. I love it. It's how you put evaluating sponsors before even talking about real estate. And, I'm a firm believer in investing in someone's character before even looking at the real estate. So, and you said it's hard to determine someone's character, but you said the best way is to ask about a deal gone bad. So the worst deal that didn't meet projections. So would you mind sharing yours or any other tips to evaluate?
Yeah, it is a very important point. If you're a passive investor that's going to invest in it's thinking about investing in a real estate opportunity, the first thing you want to know, or the first thing you want to search for, is a good partner to invest with. That people don't invest in deals, they invest in people. And, that's a point that I drive home to real estate sponsors all the time when people say, oh, I've got this deal, how do I go raise money? And it's like, you don't. The first thing you have to do is, you've got to establish a relationship with people who might be interested in funding you. And so from the opposite side of the table, if you're a passive investor, the first thing you want to do is you want to find good operators to invest with. Because if you find good operators, they're going to bring you good deals. And you don't have to worry about, sorting out deals as much if you found a really good operator. So it's really important to start there. And you're absolutely right. That point I made about character, nothing is more important in your investment partner than their moral character. I mean, if they're a thief or a crook, I don't care how good the real estate deal is, it's not going to work out well for you. And so, one of the things you're trying to ascertain is, what moral character do they have, or, what sets them apart from other people? And, things, are always hunky-dory when they're going right. When things are going right, nobody's true colors are coming out. But boy, when things go wrong, you really see what a person is made of. So, I encourage people to ask about the worst deal and what did that sponsor do to get through to the other side. Did they just throw their hands up and give up and walk away? Or did they somehow step up to the plate and go above and beyond to go that extra mile to make sure that the investment turned out to be as successful as it could be? Our story, we tell this all the time when we talk to new investors. One of the first things we tell them is the story of our worst deal, because it's really important for people to know, what we did. I mean, we had a property that we bought right before the economic collapse of 2008, literally like a few months before. And, I had bought it for about half of what the last guy paid for it. So I thought it was a great deal and my timing was excellent. And, the real estate market had already collapsed, but the greater economy hadn't collapsed yet. So we bought it. I started renovating units and raising rents and increasing occupancy. And I got it from like 80% occupied to about 99% occupied. I got rents up like $100, $150 on new leases, and everything was going perfectly for like a week. And then right after that is when all hell broke loose. The economy totally went into a tailspin. People were losing jobs left and right. And, I used to joke that, half of our units were empty and the other half weren't paying. and that's kind of about how bad it was. And, the way that we got through it is I literally took money out of my own pocket to the tune of about $15,000 a month to service the debt on that property for 3.5 years while we waited for the economy to come back. And it was enormously painful for me, but there was no way I was going to have a loan default. There was no way I was going to have my investors lose money. I had never lost investor money at that time. I wasn't about to start then. And here I am 30 years in and still haven't lost any investor money. That is that's the way you do it. Is sometimes you have to go above and beyond, and you want to know the sponsor you're investing with, did they ever go above and beyond when things weren't going well? That'll tell you a lot about their character.
Oh, that's amazing. Yeah, that's firm believer. And I think one of the hardest things is, and you hear it all the time, buying a single family home and then you bought a 100-unit complex, right? And I'm sure you're getting those questions a lot more frequently in the last 5 years or so. So what's your advice to that investor, before they even start raising capital? And do you recommend that they do deals by themselves 100% with their own, money before they go trying to risk someone else's, livelihood?
Yeah, I think you have to do your education on your own dime. And so somebody who says, oh, I did one single family house flip. Now I'm going to go buy 100 units. I'm going to do it all with other people's money. Basically what you're saying is you're asking someone else to finance your education. Now, when was the last time that you went to somebody and said, hey, I'm thinking of going to Harvard. Would you give me the money to go to Harvard? And if I get a really good job after I get out of Harvard, I'll pay you back. If I fail and I don't even get a degree, well, then your money's lost. How many people do you think are going to step up and write that check?
Yeah, not too many. Oh, that's good. That's a good point. I like that one a lot. The book is, broken up into 5 sections. So we have, investing in syndications, evaluating sponsors, evaluating the real estate, evaluating offers and structures, and the investing process. So what do you think is the most important step for a passive investor? If we've gotten through evaluating someone, we've built up trust, we understand, syndications, even though we might not have the time to become an expert, what comes across the desk as an investor when it comes to evaluating the offer and the structure of, a private placement?
It's all about the assumptions that the sponsor is using. So if you've interviewed a sponsor, you find somebody you like, they send you an offering and say, here's our next deal you can invest in. What you want to do is you want to look at the offering package to see how complete is it. Do they have complete financial exhibits that show me the dollars and where the dollars are going, all the way from the point where the tenant makes their rent payment, all the way down as it filters through expenses and debt payments, and then to the investor payment? Or are there gaps where, we see that money came in and they see the distributions that they're promising me, but how do the two numbers connect? If you can't follow the dollars from beginning to end, then that's a problem. The next thing to look for is the assumptions that they're making. And this is enormously important. The biggest mistake I think that a lot of passive investors make is they look at a number of potential investment alternatives. Let's say they've got 5 different multifamily investment opportunities presented to them by 5 different sponsors. The mistake that people will make is they'll look at all 5 and they'll go, this is the one I'm going to invest in because it has the highest IRR. Or it has the highest cash on cash return, or it has the highest equity multiple. And so therefore I'm going to make the most money with that one than I will out of these 5. That's the biggest mistake you can make, because really what it all comes down to is the assumptions that the sponsor is using. I can take any piece of real estate and I can show you any rate of return you want by manipulating the assumptions. I can change forecasted vacancy factors. I can change forecasted bad debt collections. I can change post-renovated rents. I can change rent growth assumptions. I can change exit cap rate assumptions. There's a number of different levers I can pull on to manipulate all performance indicators. People will say, oh, IRR, you can manipulate IRR. Well, you can also manipulate cash on cash. You can also manipulate equity multiple. All investment performance indicators are fully manipulatable. Is that a word? I'm going to invent a new word. If I'm a writer, I can do that now. You can manipulate any investment performance indicator. And the way you manipulate is with assumptions. So what you have to look at is, what are they assuming in vacancy factors and rent growth and, post-renovated rents and year one income and exit cap rate and loan interest rate, loan term, all of those different things. And one of the things I spend a lot of time in the book doing, and you'll notice that probably the thickest section in the book is evaluating real estate. And that's why. It's so that you can get a understanding of the various assumptions and how you should be viewing those assumptions to determine whether they're reasonable or not.
start creating a little BS meter as an investor. I like it. So what are some interesting things that you've seen as you're purchasing a property that, a seller might try to kind of get past you?
Well, as an operator, the things that I see that sellers will try the hardest to hide is going to be things like bad debt collections. That's a big one. You'll find that instead of writing off bad debt, they stack it up in accounts receivable on the balance sheet to make it appear as though they're collecting more money than they are. That's probably the big one. The other one is, the delinquencies. How many of the residents are delinquent or 30 plus days late. They tend to try to hide that. And then the other thing, and it's kind of along the same line, and this is a little bit difficult to find out, you don't usually learn this until you're in due diligence, is, what's the history of the residents that are in place at the property? Do half the people there have 3+ evictions on their record? Or is everybody really clean and, good credit, solid incomes? And that sort of thing. So that's it's really difficult to learn that early on in the process, and it's really easy to hide that stuff.
Yeah, you have some great charts in the book as well. Is coming across like the T3, the T12, and then the broker's portfolio, and what's the thing that's glaringly obvious? I love that. That was a good one. So I want to talk about, I think one of the hardest things for me personally to understand in the beginning, and in the CCIM course, I'm halfway through, and that was probably one of the best educational sources, besides meeting people like you and reading books. But the absolute hardest was to determine the exit cap rate. And for some reason, I can never wrap my head around this. Gross income, vacancy expense, CapEx, like that all makes sense. But a cap rate 5 to 10 years from now, just absolute guess in my mind.
Yeah, and you'll notice in the book we talk a lot about exit cap rate assumption, and it is a little bit art and a little bit science. And so for the passive investor, your job is to determine whether or not the assumption that the sponsor is making is reasonable. Well, I'll say this. First, your job is to see if the sponsor is even telling you what their assumption is. I mean, so often you'll get an offering to invest in, and you have no idea how they're guessing what their exit price is going to be 3 to 5 years from now, and they're not sharing that information with you, or it's not right there in the offering material. So first, are they even telling you? Second, if they are telling you, is what they're telling you reasonable, and does it make sense? And for most people, they would go, well, how would I know if it's reasonable or not? How do I know what a cap rate should be 5 years from now? And admittedly, it is very much art and very much science, but we have a very specific way that we look at exit cap rate assumptions. And what I do is I look at what are properties selling for today, what cap rates are today's trades taking place. And you can tell that usually by, what cap rate is this property selling for? And, if there's 20 offers on a property and 5 of the offers are all within $100,000 of each other on a $20 million deal, you can be pretty sure that the market price is right around that price point. What's that cap rate? That's telling you a pretty good indicator of what the cap rate is for this property as it sits today. Then the next thing, so that's your starting point, right? So everything is like a building block. So the next thing you're going to look at is you're going to look at what's the overall market and economy and what are the prospects for the future. And, I would have told you, a couple of months ago, I would have said, well, things are going about as good as they can be. Rent growth is still pretty robust. The vacancies are low and projected to remain so. So, the market's really pretty strong, but, there's going to be a downturn at some point in the future, and, interest rates are going to be higher. That means borrowing costs are going to be higher, and maybe things don't go as perfectly 5 years from now. So I'm going to assume that my exit cap rate is going to be higher than the cap rate that something's selling for today. Well, as we're recording this, we're in the midst of the COVID-19 pandemic. And, now cap rates are going to adjust upward as a result of that, because assumptions are going to change as far as future rent growth and occupancy levels and collections and so on. So now you might argue, 5 years from now, perhaps things will be better than they are today, and maybe cap rates stay level, or even compress if they decompress during this pandemic. So, you just have to look at whether you think real estate will be more or less desirable 5 years from now than it is today. And that's going to tell you which direction you're going to consider moving the cap rate.
Mm. So that's one of the big reasons we're going for a strong, well-diverse economic, center. And that's why you're picking, some of the best cities to invest in with the positive job growth that, well-diversified. What do you look at in terms of a history of that economic standpoint, for that city? So let's say, Los Angeles, how far would you go back to, try to determine like a real estate cycle or any common themes that you can see?
Well, first of all, I can't find any excuse to invest in California, so let me pick a different market.
Sorry. Yep.
We could say, look at like Phoenix, for example, or Tampa, or Orlando, Florida, or Atlanta, Georgia, Charlotte, North Carolina. There's a number of cities in the United States where people are moving to, and one of the things we talk about in the book a lot is the big drivers for multifamily performance there's three. It's income growth, job growth, and population growth. Those are the three drivers of multifamily fundamentals. So if you look for cities and metros and states or regions or even neighborhoods where you have an increasing population, you have wage growth, and you have job growth, you're going to have a good foundation for multifamily performance from a fundamental standpoint. So we're looking for markets that possess those characteristics and do so repeatedly over time. So each year you're finding them to be in the leaders. And it's funny when you look at a variety of different indexes of cities with the highest job growth or cities with the highest population in migration, it's almost always year to year the same suspects. It's always like, for the last 5 years, it's been the major Texas metros, Phoenix, Atlanta, Orlando, Tampa, Charlotte. It's been those markets have historically been the strongest, and they continue to remain to be so. And you'd expect that they would continue in the future. And every once in a while, one market will drop off and a new one will pop on. So those are the things that we're placing the most focus on.
Amazing. Now, how important is sponsor communication during that investment hold period? And do you like to send out, monthly newsletter, any personal calls, good or bad?
Yeah, investor communication is really important. And one of the things that I talk about a lot in the book is reporting and what you should expect to see in your reports. And, there's quality and there's quantity. And there's a bit of a balance because, the more often you communicate with investors, probably the lower quality each of those communications are, because it takes a lot of time to put together a real high quality report. So frequency of communication, while good, it may not be as in depth. In more infrequent communication, maybe is more in depth, but isn't done as often. So there's trade-offs actually to both sides. I like to look at it as a balance. And, describing what we do is, we do a quarterly report, which is really in depth, where we go into detail about what's going on at the asset from a performance level. We make comparisons to actual performance versus forecasted performance. We include a full set of financial exhibits. We talk about anything that's going on, good, bad, ugly, or otherwise. We just deliver the news as the news is. We don't try to sugarcoat it. This is what's going on. So if, in between there's a particular reason to communicate with people, then we absolutely do so. And we're finding that need, at times like this during the COVID-19 pandemic, for example. People are curious, what is our plan? What are you going to do? How are you going to safeguard collections and maximize collections and that sort of thing? So, very early on, we sent out a series of emails to investors saying, this is what we're doing at a property level from a physical standpoint to keep people safe. And then followed up by about a week later with, this is the things that we're doing to, ensure the best performance. And then, once we have some, viable data, we're going to share that with people to say, this is the result of all that hard work, and this is what the performance is looking like, and that sort of stuff. So, we've had several fires. So, if a building burns down, we'll send out an email. Hey, this building burned down. So, I'd rather you get an email from me than watch it on the news. So, it's communication is important when there's news to communicate. Giving a weekly update just for the sake of giving one, to me, is kind of a waste of people's time, and they'll just get bored of listening to you. So I think having there's a just right balance that you can strike.
That's great. Great tip. Now, appreciate your time very much, Brian. Before we wrap things up, what's some of the best real estate advice you've ever received?
Oh man, best real estate advice I've ever received. Probably that it is more difficult to get out of a bad deal than it is to get into a good deal. I think that's probably the best one. That will save you a lot of heartache if you follow it.
That's deep. I like it. Awesome. And before we wrap things up, Ryan, what's the best place to find out more about you, more about your business, and also where to purchase the book from?
Yeah, so you can find me a couple of ways. Our company website is praxcap.com. Our company is Praxis Capital. The website is praxcap.com. I'm also pretty active on the biggerpockets.com forums and write for the blog. So you can find me hanging out around there answering questions. The book is available at biggerpockets.com/syndication book. And it's if you buy it through biggerpockets.com, there's bonus content that you get access to. There's a bonus chapter. There's a list of, I think it's 70 questions to ask an investment sponsor. There's 2 interviews that I think passive investors will find very valuable with other passive investors. And then you also get the book. So that's one way. It's also available on Amazon and bookstores starting May 5th.
Great. Yeah, no, that bonus material is awesome. That's well worth the investment. So I appreciate it. Thank you very much, Brian, for your time, and glad to have you on. We touched a lot of great topics.
Thanks for having me on, Scott. I appreciate it.
Thanks so much for listening to this show of the Book Club Interview with your host, Scott Hollister. If you enjoyed today's episode, please leave a review and subscribe. And we'll catch you next time on the Book Club Interview.